Okay, everyone, we're going to get going here. Hello, everyone, and thank you for joining us today. We're going to start off by doing some brief introductions. Starting with myself, my name is Tom Dowling. I'm a partner here at Whittlesey, working mainly with closely held businesses and nonprofit organizations. I've been working with many clients prepare for this lease accounting standard implementation over the last several years, and happy to have you all here to share some of the information you'll need to know. Here today with Sean Sheridan and Nick Dietz. Sean.
Good morning, everyone, or almost good afternoon. Like Tom said, I'm also work with a lot of closely held companies, specializing more in construction and manufacturing. Also through there, I deal with a lot of our employee benefit plans. And like Tom said, we've been dealing with a lot of this on clients, mainly smaller leases, but we've been trying to get it set up so everyone's in good shape for this year. And hopefully this seminar helps out a little bit with that. And Nick?
Hey everyone, my name is Nick Dietz. I'm a manager here at Whittlesey. Been here for the last 8.5 years, and I primarily concentrate in construction, real estate, nonprofit, and benefit plans.
All right, so a few housekeeping items first. This is a webinar, so everyone is on mute. If you have any questions, please submit them to the Q&A chat, and we'll do our best to monitor those as we go. And we'll plan on answering any questions towards the end. We only have 30 minutes for today's webinar, so we do plan on being very respectful of your time today. So before you can see our planned agenda, very brief. We're going to provide an overview of the lease standard known as Topic 842. Throughout this webinar, we will refer to it as either the lease standard or Topic 842. We will then look at some practical expedience to ease your adoption, an example of the accounting behind the standard, and then lastly, take a look at what you can expect for presentation and disclosure in the financial statements. So starting off with some basics, more of a refresher. So what is the reason for this? Well, Topic 842 was designed to increase transparency and comparability of lease transactions for all organizations. It's doing this by requiring all leases be recognized on the balance sheet. As we all know, previously only capital leases were included on the balance sheet, while operating lease payments were expensed on the income statement and disclosed in the footnotes to the financial statements. It's also going to be removing concepts such as deferred rent, prepaid rent, called a right of use asset on your assets, and lease liabilities in your liabilities. What also changed is the definition of what constitutes a lease. The new definition is going to focus more on who has control and the ultimate exchange of consideration. This is going to align the lease standard with Topic 606, which was the revenue recognition standard implemented over the last several years. In terms of lessee versus lessor, if you're a lessor, good news, there's really no significant changes to lessor accounting. This is really more impactful for the lessee and is why we're going to focus only on the lessee today. For types of leases, there continues to be only two types of leases: a finance lease, which previously we referred to as a capital lease, and an operating lease. And ultimately, both types are now required to be presented on the balance sheet. The definitions of commencement date versus inception date is very important to know because the classification and measurement of the lease is performed on the commencement date instead of the lease inception date. The commencement of the lessee, so again, when the lessee gains control over that lease or that property, it's not necessarily going to be the date the lessee begins making payments. So for example, if you enter into an operating lease 2022, but you don't start making payments until September 2022, the commencement date would be July 2022 for purposes of recording your right of use asset as you gain control over the space in July. So it's a very important distinction between the two and something to be aware of. In terms of classification, not a lot changed here. You're ultimately going to be asking yourself, how do I classify between a finance and an operating lease? So similar to the old guidance on what previously constituted a capital lease, you would review each lease to determine if any of the four items are true. The first being, does ownership transfer at the end of the lease? 2, is there a purchase option that is reasonably certain to be exercised, such as a bargain purchase option? 3, is the lease term for the major part of the remaining economic life of the asset? And finally, 4, are the present value of lease payment amounts substantially all of the fair value of the underlying asset? If none of these are met, you will classify your lease as an operating lease. If you meet any of these, it's going to be considered a financing lease. The recognition for both operating and finance leases is very similar for the balance sheet, but will differ slightly for the income statement and cash flow presentation. And Nick will speak to that a little later on. In terms of the accounting, so once you've determined whether the lease is a finance or operating, you need to calculate the lease liabilities and the right of use asset. So you're going to begin this process by calculating the lease liability, which is the present value of the future payments at commencement date. Future payments should include all fixed payments on the lease, so your monthly payments and any purchase costs at the end of the term, terminations, and things such like that. In order to calculate the present value of anything, you're going to need a discount rate to use, so you have a few options to choose from. The first being if a rate is implicit in the lease agreement, you're going to use that. But if there's no rate stated in the lease agreement, you can either use the risk-free rate of return or your incremental borrowing rate. And the incremental borrowing rate would essentially be the rate your bank would give you if you were to looking to finance this. And ultimately, the higher the rate used, the lower the present value of your lease liability. So at today's rates, we're looking at decreased lease liabilities on the balance sheet. Once you've calculated the lease liability, you can proceed to calculate your right of use asset. You're ultimately going to start with the liability that you just calculated, and you're going to add initial direct costs, which are things like commissions paid, legal fees to structure the lease, and so on. You're then going to add or subtract prepaid and accrued lease payments. And as I noted earlier, this standard removes those concepts. And lastly, you're going to subtract any unamortized lease incentives. And Sean will be reviewing the calculation shortly to help visualize the mechanics behind this. So now that we know what it is and how to calculate it, we're going to find out how to simplify the adoption with some practical expedients. The first being the short-term lease expedient. This is one that everyone should elect upon adoption, and is where the lessee may elect not to apply Topic 842 to leases of 12 months or less, and will simply continue using existing lease accounting. The advantage here is that it's going to save time on accounting for short-term leases. The disadvantage is that you're going to have a different policy on short and long-term leases to account for. So for example, if a lessee enters into a 12-month lease of a vehicle with an option to extend another 12 months, which the lease would fit the definition of a short-term lease, and the lessee will not need to recognize the right of use asset and lease liability. On the other hand, if the lessee were reasonably certain to exercise the extension for another 12 months, it would no longer be considered a short-term lease, and this practical expedient would not apply. This is in terms of non-lease components. Let me go back one more. You can elect to account for lease and non-lease components as a single combined lease component. The advantage here is the lessee will not have to allocate between lease and non-lease payments, which will save you time. Disadvantage is by treating them as one component, the lease liability and right of use assets calculated will be much larger, which could have more impact to your balance sheet. So for example, if you have a lease with a $5,000 monthly rent payment and a $500 monthly CAM charge, your common area maintenance charge, this election would allow you to treat it as a single combined lease component of $5,500. If you did not make this selection, you would simply use your fixed monthly payment of $5,000, but spend more time documenting and breaking out all those different lease components. So the next item are some transition reliefs. The first being it's a package of 3. You must apply all 3 of these. So it's an all or nothing election. The first, you need not reassess whether any expired or existing contracts are or contain leases. You need not reassess the lease classification for existing or expired leases. And third, you need not reassess the initial direct cost. So this is another practical expedient that everyone should elect to apply in year of adoption. It's going to save quite a bit of time during implementation. The hindsight election allows you to use hindsight with respect to lease renewals and purchase options when determining the lease term. And finally, just overall implementation. It does require the use of a modified retrospective method. So you have two options. You can either, one, restate prior periods to maintain comparability of financial information. So if your financials presented both 2022 and 2021, you would restate your 2021 under this new standard. You'd record an adjustment to beginning retained earnings in 2021. And under this method, since you restated to present both years under the new standard, you would only be required to use the new disclosures and footnotes. The second option for implementation is the cumulative effect as of the date of adoption. So as we approach year end, that's going to be January 1st, 2022 for most organizations. If you're a nonprofit with a June 30 year end, that's going to be June 30, 2023 is when we'll work on implementation. Under this method, an adjustment would be recorded to opening balance of retained earnings in the period of adoption, which would be January 1st as we approach. Your prior year information will be reported under old lease accounting, while the current year is under topic 842, the new lease standard. And this approach will require new and old disclosures for the year of adoption. So more information required in your footnotes as you'll be presenting both new and old disclosures. We believe most will be electing this method as you're really only working on or restating 1 year, which is the current year. Ultimately, the choice of implementation and presentation is up to you. What's best for your organization and the users of the financial statements. So you really must identify what the user's expectations are and what is important to them in deciding the best implementation method. Now I'm going to hand it over to Sean, who's going to walk us through an example and help visualize the accounting behind this standard.
So now that we've gone through all those slides, what does it mean? Here's the easiest thing. So what we kind of pulled together here was more of a building office lease. We figured that's going to be the most common one that our clients are going to experience. I bet 90% of people, this will be the main thing that's going to be with this new standard. So here's the summary of what this company is. I'll go through this. We threw a couple curveballs in here so you can kind of see how it plays out when we do the math on everything. But so this company's books are on a calendar year. It's not a related party, so it's a third-party lease. They've gone through the slide that Tom showed, and they've determined it's an operating lease. It's monthly payments due at the end of the month. The lease period, here's one of the curveballs, is July 1 to June 30th. The lease expires in 2024, but the company has this option to elect a couple more years, and they expect to exercise this. So we're going to add that to our calculation. And then at the end of each annual lease period, it does have an escalation, and it's going to be $500 that they threw on there. And then they chose to go through their incremental borrowing rate. So they went to the bank, and their 5-year commercial mortgage rate was 6%. So that's what we're going to use as our discount factor. Nick, can you flip over to the lease? So on this slide here on the top, you'll see how everything plays off annually and monthly based on the actual lease, which goes from 7/1 to 6/30. So what I did is adopted it at a calendar year on how it's going to apply out to this company since they're a 12/31 year end. And you can see the cash flows that are going to go out way on the right there. So from this data, Nick, can you flip over the amortization? You'll see what I did here is we have some complex stuff that we develop internally for tougher leases. I just kind of wanted to show that this is an easier one. And if you have an amortization program on this one, I just use T-value that you can kind of do it on your own. So what we did is we took the lease pay, the data up top there. You can see the lease payments, 10,000, 10,500, so on. We use the 6% factor, and we come up with a right-of-use asset of 522,000 up top. Now, one other question that people have asked me a lot, and for this example, I just want to show how everything plays out to zero in the end. So I just did an annual entry, but I'm guessing it'd be much easier if you set up a procedure for when you actually go and make your actual lease payment, you do this entry monthly. I think that'll be a lot easier. So in this example here, It would just be the principal payment would be knocking down your lease liability as you make your normal payment. So on that note, Nick, why don't we flip back to the actual color coded stuff here? So the green, blue, and tan here are coming from the amortization schedule, and above you'll see where the actual cash flows are. So as I said before, our initial opening entry is going to be bringing on the discounted amount of this. So you see it came out to the 522,000 there in yellow. Then, like I said, we did annual entries here. So our lease expense is going to be, if you scroll up at the blue there, it's going to be the amount of the lease monthly over the life of the lease times the months we're doing this is a calendar year. So it's going to be 133,000. So you'll see it's slightly different from the actual cash flows that were going out. People have asked me on this too, what they think about, can I stick with the old cash flow method? Technically, that's not GAAP, but it's materiality. In this example, you'll see it's only like $10,000. So it's going to be up to you on how you want to do it, but this is the correct way if you want to do it. So if you scroll down to the 22 entry there, this is going to show you how the initial entry after you set up the right of use asset and the lease liability. So the lease expense, as I said, is going to be the 133,000, the blue number there. The principal from our amortization schedules is 94,000, which is going to knock down the lease liability. The actual cash flow that's going out, the payments are going to be the 123,000 based on the actual lease. And then kind of the delta on this is the right of use asset. And so you just make this based off the amortization schedule. And Nick, if you want to scroll down a little bit so you can see the end. On the right here, I kind of tried to show how these entries are affecting both the assets that you'll see on your the asset and liability that you'll see on your balance sheet. And you'll see it kind of decreases, not at the same amount, but in the end of the lease, you'll have a zero on both. Now, how does this affect the income statement? Honestly, it's going to be very similar to what we were doing before. It depends if you were calculating your lease expense based on the escalations in the lease, or you're just doing it on cash flows. But again, like I said, materiality wise, if you want to go back to doing the actual cash flow method, it might not make a big difference. One other thing I wanted to mention on leases, a lot of people have asked me is, so do I have to do this for everything? And we're telling clients, you know, if you have a copier lease, I wouldn't do it on that. If you have a one car lease, you have to look to see if it's material on your end. Maybe don't do that. It's more these building leases, these larger leases that are going to have, you know, effects on your bank ratios and stuff like that, that you kind of want to implement this new standard. And then I see some questions are coming up later. We'll address them. Nick, do you want to go on to your part and then we'll finish up in the end?
Yes, thank you. So I'm just going to go over some of the presentation and disclosure matters related to the lease standard. I know that Tom and Sean have both discussed some of the items a little bit, but just to put it all together for you. So starting with the balance sheet. So as was mentioned, now there is both a right of use asset and a lease liability on the balance sheet for both operating and finance leases. And they are required to be presented separately from each other and from other assets. That's one method of doing it. And that's probably the more common, especially if the number is, material in amount, then, you'll just have a right of use asset line on in your assets as non-current, and then, a lease liability non-current as well, separated by operating and finance. You can combine them with other assets and liabilities if you choose to do so. And then in the footnotes, you'll have to explain how much, of that line item is made up of the right of use assets and the lease liabilities. But under no circumstances can you combine the operating and finance lease assets and liabilities on the same line item on the balance sheet. So, and then if you have a classified balance sheet, you will, split out the short-term and long-term portions of the assets and liabilities as well. And on the income statement for finance leases, the interest expense and the, amortization goes with the same classifications as they have in the past with capital leases. And for operating leases, the entire lease expense goes on one line item, similar to how rent expense was classified in the past. On the statement of cash flows, so for finance leases, the present interest expense is an operating activity, and the reduction to the liabilities are financing activities. And then for the operating leases, everything is presented as an operating activity. So your changes in assets, liabilities, and any expense items that are being backed out all go under operating. And relevant disclosures. So all of the significant lease terms and assumptions, similar to what you were disclosing before, as far as the terms of the lease, you have to add additional information about leases that have not commenced but will be significant. And some of the quantitative information that needs to be provided would be the finance lease expense, separating the interest from the amortization, operating lease expenses, and any sublease income. And continuing with that, you also need to disclose any cash paid for amounts that are included in the lease liabilities, any non-cash information related to new leases during the year. You have to disclose the weighted average remaining lease terms and the weighted average discount rate. And as was done in the past, you have to put in a schedule for future lease payments for the next 5 years and then thereafter, which reconciles back to the lease liability and any future lease payments for short-term leases. And if there are any lease modifications to the leases, if there are no additional rights of use and the term is either extended or reduced or the consideration is changed, then you do need to remeasure the lease liability using a discount rate at the effective date of the modification. And then you adjust the lease liability and the right of use asset accordingly. Now we're going to address some of the questions in the question and answer. Please feel free to continue to ask those as we go through, and we'll do our best to answer them.
I guess I can take this first one, Nick. It says on here that we renewed our lease this year, but we had 6 months that carried over. I'm assuming those 6 months were in 2022 and we're going to elect to do on 1/1/2022. The answer would be yes, you would include those, then add on the new lease payments on the additional 5 years. Plus, if this is a non-related party lease, you want to look to see if there's any other additional extensions on the lease too that you want to add in to your calculation. And I think the next one is about interest rate. We don't borrow. I mean, just to answer, I would probably go online to a bank rate and just see whatever. So in this case, if you have a 5-year lease, just to see what the 5-year borrowing rate from the lease is. Otherwise, you should be using, the risk-free rate or any rate that's implicit in the lease, like Tom said.
Yeah, just to add, so the question was, can you use the prime rate as the interest rate because you don't borrow? You are allowed to make an election to use the risk-free rate of return. In situations like that, you don't have to go look for an incremental borrowing rate if you're not aware of one.
But sometimes using the borrowing rate, like you said, it's going up, so it'll bring this amount down a lot, which is kind of nice.
We've had a few people ask if they can get a copy of the spreadsheet. So yes, we'll certainly send out that example after the webinar with.
Yeah, I'll put my Venmo account up. If I get $500, I'll send it over.
There you go. Last question posted here is, do we need to do this for related party leases as well? And that answer is going to depend. For related party leases, it's really dictated on what is legally enforceable. So if there's a lease, a written lease or written contract in place, then you'd have to follow that. If not, it gets a little more gray.
Yeah, it gets a little easier on, I think, the extensions on the lease, because if it's a related party lease, you're probably going to stay there forever, so they don't require you to do some of that. Mm-hmm. Another thing I've seen some clients do is that before we used to break the related party lease out, and we take that exception, so we wouldn't put the building on the balance sheet. Now, don't forget, if you bring the building on the balance sheet, this stuff doesn't apply anymore because you're not paying lease payments. So that's another option if it's a related party lease.
Yeah, that's good. We have another question that came in asking, what is the threshold for materiality? So materiality is not mentioned within this standard, so there's no set threshold. You're really going to have to use your judgment and potentially draft policy of capitalization. So similar to your current capitalization policy, you might adopt a new one for how you're going to approach this lease standard based on the leases you have in place and what you expect to have in the future. But a lot
I
of
would
it
kind
has
of-
to do with judgment.
It's going to be a lot talking to your, whoever the users of the financial statements are too. So after the banks adjust their ratios for this, if you think that a lease would affect those ratios, you probably should be including it. It's going to come down to decisions kind of like that. It's like client by client, I would say.
Good questions, everyone. Thanks for posting those. We have a few more minutes. We'll leave the Q&A open. If you have any more, feel free to post them now. If not, our contact information is on the screen, so feel free to reach out to Sean, Nick, or myself, or if you work with another advisor here at Whittlesey, feel free to reach out to them, and we can set up a time to talk through some more of your questions and potentially more of your real life situations that you're finding yourself in.